Well, I think the first thing I should get out there, good afternoon everyone, is to explicitly say that I do have a robust sense of the imposter syndrome that is entirely appropriate anytime anybody from financial services and investment banking speaks to people from industry. But I hope you'll indulge that, and I hope what I have to say may resonate and be vaguely interesting. By the way, as an FCA-regulated firm, we're obliged to have all this governance up, so I hope you can all read that extremely quickly for the tape. So yeah, thank you very much for that introduction. I do genuinely feel self-conscious that bio was read out in full. I did think you were going to cut that down, give you some optionality. But yeah, I'm a finance author of my sins. Delighted to have published this book on biotech in August, which happily is selling, it's not only family members who are buying copies, pleasingly enough. And I founded, so I was a partner at WG Partners, which was basically focused on IP-driven life sciences businesses. So that's the whole spectrum, and I'll get into, biotech, therapeutics, medtech, health tech, et cetera, but not kind of care homes or hospitals or whatever else, IP-driven stuff and international, globally relevant stuff. I've founded two businesses, Plain English Finance, which basically teaches financial literacy, and that's a function of my first book, the one at the top. And of more interest for today and relevant to why I wrote the second one is a business called the Conviction Life Sciences Company, which seeks to basically leverage the thesis that I'm going to articulate in hopefully about 20 to 30 minutes. We'll see how I go. I can get verbose. So, and by the way, do interrupt if you want to at any point and hurry me up. So I began my career at Swiss Bank in the late 90s. 25 years, most importantly, focused on smaller company equities. So in the vernacular of the London stock market or the European stock market, that basically means anything that's sub about 5 billion euros or dollars or 3 billion pounds. And 10 years now focused on life sciences and biotech specifically, and as Paul said, acted for 60 companies whilst at WG. It really is an honor to be here, and I'm going to give you a presentation in 3 parts. And I think the first thing I want to say is the first part, I expect, will be that horrible expression, teaching grandmothers to suck eggs. Does anybody know where that expression comes from? I certainly don't, but you understand what I mean. I'm going to set out the first principles case for biotech, life sciences, biopharma, because I think coming from an explicitly financial services background, that's what I do, because that's what I do for a generalist audience all the time. So please forgive me if most of you know most of the things I'm going to cover in the first third of the deck, but to a certain extent, I hope that it might be refreshing to kind of go back to those first principles and restate just why it is so exciting, notwithstanding all the concerns about recruitment and everything else we've covered in the last hour and a half. I'm then going to move on to what is, the reason I've just spent 3 years getting up at 5 in the morning to write a bloody book, is the unbelievable challenges facing the industry, notwithstanding how exciting it is, and particularly in this country. And I don't want to get all jingoistic and nationalistic, but ultimately we're all in London today, and the challenges to funding for British companies and people acting in Britain are legion. And I just wanted to talk about that a little bit to sort of unpack the detail behind that, and then move on to, okay, what does that mean? Why that presents an opportunity, and what the conclusions and sort of key takeaways from that reality should be for all of us in this room, no matter kind of what your job description is. Before I go on, I did just want to throw a question to the room, which was, can anybody shout out, slightly spurious thing I like to do, does anybody know how many London stock market listed companies there are on the London Stock Exchange today, including AIM, the junior market, the alternative investment market? This room of biopharma industry professionals, how many companies are on the stock market in Britain? That's a very good estimate. So it's just shy of 1,800. Crucially, and hold this thought into the second bit of my presentation, how many were there 30 years ago? 3,250. And I am blown away that this reality is not an electoral issue. It's not talked about in the press. We heard loads about Rwandan refugees and Angela Rayner's tax affairs in the election last year. Not one thing about what I think is the paramount cause of the travails of this country at the moment. And it's, I think, the reason I feel it so acutely, the importance of the stock market for vigorous capitalism, for growing businesses, is because I've been in the life sciences business, which has been the hardest hit, as many of you will be familiar with. So, part one, let's talk about why structurally this is, an extraordinarily exciting sector. And, I just spent several years writing a book to articulate all of this. you will know all of this, but when I'm talking to generalist investors, I just sort of want to quickly define what do we mean by life sciences, familiar to all of you, but it is therapeutics, it is medtech devices, diagnostics, consumables, CROs, CDMOs, the whole spectrum of the industry. Because often, the reason I want to say this explicitly to my sort of audience is because often you go and see a generalist investor and they just think it's flight to the moon, crazy, risky companies that might cure cancer. And it's so much more than that, especially with the move into digital and AI and machine learning and everything else we've been talking about today. And then up here, boxes, again, for a generalist audience, you'll be familiar with most of these therapeutic areas, these areas of excitement, but it's worth just dwelling on the fact that the compound annual growth rates being exhibited by these things right now are somewhere between 20 and 30%, and that's forecast to carry on for the next 5 to 10 years, which is remarkable in terms of value creation. And it's the reason that many of them have gone from a standing start of effectively not existing technologically in the last sort of 5 to 10 years to being worth $100 billion or more already. You know, and I think a number of these are trillion-dollar opportunities plus, which is very exciting. And this is already an extremely large market. So the top 700 biopharma companies in the world, in aggregate, valued at $5.5 trillion by the end of 23, which is the last numbers available. By the end of last year, it actually is probably higher because of people like Novo Nordisk and other businesses that are developing, notwithstanding how challenged some stock markets have been outside of the United States. And global pharma revenue is already at 1.6 trillion in 23. I assume everybody in this room knows these statistics. Is that fair? If you know that 1.6 trillion number, please raise your hand. Okay, I was wrong. And I think what's also, again, for my kind of generalist investor audience, back to the point about this is a flight to the moon, super risky stuff, the really big bits of this market are exhibiting compound annual growth rates of 12 to 13%. That's remarkable. That seldom happens in economics, full stop. The cancer drugs from 176 billion to sort of north of 300, we all know about that. I suspect many of you are involved in that reality. And the CRO market exhibiting fantastic growth rates in aggregate. That's a huge opportunity for generalist investors, particularly because CROs are a bit easier to understand than sort of cutting-edge therapeutic biotech businesses. So just further on the sort of aggregate opportunity, these are 3 quotes that, again, you'll be very familiar with, although perhaps less with the last one. First, it's Nobel Prize winning. That's the Nobel Prize press release from the CRISPR Nobel Prize for Chemistry, which you'll all be familiar with. Secondly, it's really very recent. And I've said it within the last 10 to 5 years here from Melanie Senior, who I'm sure many of you read. Even being a scaly-skinned stockbroker, investment banker character, you know, when I speak to my audience, when I get to meet CEOs of small biotech businesses, it's absolutely astonishingly science fiction what's happening. Stuff that's happening in the last few months is you know, a step change from stuff I was seeing 3, 4, 5 years ago. So this is very recent and it's very exciting. And you know, for my investor audience, why is this interesting? Well, it's interesting because of the value creation. And McKinsey said, this is actually a few years old now, you know, which comes into the point I'm about to make, but 60% of the world's physical inputs could be made using effectively biotech. So this is replacing packaging with cellulosic packaging. This is actually so much more than therapeutics. It's clean power generation. You know, it's biocoatings on photovoltaic cells. It's DNA-based computing. It's agricultural productivity. It's bioremediation technologies. You know, this is extremely exciting. And 2 to 4 trillion of economic potential. Well, I just showed you on the last slide, we're already at 1.6 trillion last year or the year before, just in pharma revenues. So I think that considerably underestimates the aggregate value creation in this sector. And why is that? Well, because, again, this is a slide I get very excited about because life sciences exponentials, I think, to a great extent, are demonstrably more exponential than tech exponentials. And if you like, the last century has been about physics, and the next century will be about biology, for fairly sort of prosaic, intractable, inherent reasons. So that's Moore's law. And show of hands, who knows what Moore's law is? I mean, basically, the processing power per dollar, pound, euro, whatever spent per doubles every 18 to 24 months. And Gordon Moore, the founder of Intel, came up with that in the 60s. It actually goes all the way back to the steam age, amazingly enough, and that's a chart that shows it. And that is absolutely front and center, the single most important driver of the returns of equities in the last century. And they are, at the moment, until the Magnificent Seven fall 50%, which may or may not happen. Let's hope it doesn't happen. But I think that we are very stretched when we look at US equities. But the end of last year, equities have returned 10.6% per annum for a century because of Moore's law, and because we've created several trillion of real wealth, and that's most obvious with the Magnificent Seven, big tech stocks, and Nvidia's not on there because I first did this slide a few years ago. But it's not just directly through the big tech companies, it's indirectly through the revolution to every single industry engendered by tech and Moore's law and all of this scientific development and R&D. Life sciences, we think, are on the cusp of doing something similar into the next century, because basically, prosaically, almost all of mankind, I mean, without wanting to sound too hyperbolic, all of our biggest challenges as a species that remain are not problems of physics anymore, they're problems of biology. You know, whether that's environmental degradation or power generation, all the things I talked about a moment ago. So what is the industry that's best placed to solve that? I mean, you know, for people in this room, curing cancer, or dealing with Parkinson's, or you know, whatever other therapeutic indication. And just to go to the final point about the more exponential, you know, biotech is more powerfully exponential than tech. That's the bottom chart. There's the biology exponentials, which again, most people in this room will be familiar with. The cost of sequencing a human genome is one of the only exponentials that has left Moore's law in the dust for 2 decades. And everybody here will be familiar. You know, that chart shows 100 million down to sub $1,000. It was actually estimated to be between $3 and $5 billion when we first sequenced the human genome, and took tens of thousands of scientists, you know, 13 years. Now it takes a few hours and less than $200. That's going to create an awful lot of value, and not just in therapeutics. So in the next 3 slides, I'm just going to really quickly trot through really kind of obvious structural drivers. And again, this is with a capital markets kind of investor hat on when I consider the sector, but hopefully it's germane to most of the people in this room, and hopefully in terms of cheering up about the potential for the business at least, and fewer redundancies and problems with recruiting. So it's all about demographics and global growth. You know that, you know, cancer's a disease of age. The world's becoming more obese. There are lots of diseases in modernity. Why are all of these diseases in modernity on the rise? That's a big part of my book. What's the kind of smoking gun and what we've changed since the agricultural and industrial revolution. And it's growing. China's already the second biggest healthcare market in the world. Everybody knows that's super hot at the moment. Everybody's trying to license inexpensive Chinese assets and quality Chinese R&D. It'll be the biggest healthcare market in the world reasonably soon. So that's a big structural driver. I'm interested to see the reaction of this room in terms of the point I made here about an improving regulatory environment. Any heads shaking? Well, that's what they tell me. That's what all this... well, you know, set against that, it is a kind of unimpeachable fact that the NMPA, you know, a decade ago had no review scientists, and today it's got knocking on 1,000. That's a big change. COVID is obviously a hell of a hot potato. You know, I made the comment at again, a generous investor thing the other week that I don't think the fact that we got a COVID vaccine in 10 months has anything to do with Her Late Majesty the Queen and Bill Gates trying to microchip us all. I think it's just the more or less prosaic confluence of science and everything else that is the reason that happened. And it does compare to 45 years that it took us to get a polio vaccine, right? I mean, this is interesting. This is logarithmic. It's exponential. And that Linklaters quote just sort of underpins that idea of relaxing regulation. But it sounds like this audience will decry that as a point, so I'll move swiftly on to the next one. It's a key strategic sector for governments. It has been, it will continue to be, because it pays high wages. It's, you know, there's a lot of talk in the UK about it, and a £1 billion life sciences investment programme, which in the context of a £2.4 trillion economy and 53 billion on defence, I don't think we've got our priorities right, but, you know, I'm sure I'm preaching to the choir with respect to that in this room. I mention Australia because with my investors hat on in this space, I think Australia, like the UK, is structurally undervalued, which is why I'm focused on it. And they've also got these fabulous super funds, which mean that the Australian biotech could be a very exciting place in the next few years. Because if Canberra decide to sort of support Aussie heroes, that could be very interesting for Australian biotech and the funding of Australian biotech. And similar, you know, we all know about how the US and Europe and how many billions of euros, dollars, whatever else there are supporting the sector. It's also basically the biggest balance sheet of any sector. There's Ernst & Young every year do a firepower survey of the biggest biopharma and pharma companies, and basically a firepower score is you take their current balance sheet and you gear it up to a net debt to EBITDA ratio that's sustainable through the cycle, and that gives you how much they could spend on M&A. So obviously Novo Nordisk today has a much higher firepower score than it did 3 years ago or 10 years ago. And it's always $1 trillion or more. That's enormous compared to every other sector. Then you've got specialist VCs and PE firms all over the world who are another trillion. Then, and this has become a toxic word in recent years, ESG. ESG was immensely hot, as I'm sure you all know, for a long time. And it's biotech, pharmaceuticals, surprisingly enough, are actually the #1 rated ESG sector because of patient outcomes and doing good and curing cancer. And there have been several $1 trillion of fund flows into ESG specialist funds in recent years. So this is massive, massive pool of capital that's available to support people like you, hopefully, although there are caveats coming. And the last one is just old school. If you're a student of equity markets, Equities 101, life sciences companies that succeed and deliver and get through the clinical and commercial trajectory to delivery are uniquely excellent investments because they have high margins, strong cash generation, the patent moat, long duration IP. And when they exit to mega pharma, when a biotech exits to a big pharma company, they're at really, really serious premiums, as again, I'm sure most of you experience. But notwithstanding all of this, I think we're at an inflection point. And now we're going to look at just how absolutely awful the UK is for funding life sciences and why that is. So I've lived and breathed this for 10 years, kind of at the coalface of speaking to institutional investors and trying to help. The sort of companies I work with range from a couple of scientists coming out of Oxford or Cambridge or another British university with great IP who just needed to raise a few £1 million to get going, all the way up to selling BTG to Boston Scientific for £3.5 billion and sort of everything in between. And I used to joke, well, I'll come back to that. But basically, despite all of this amazing stuff I've just said, outside of the United States, if you're a student of equity capital markets, this is an unimpeachably factual statement. These companies are unbelievably structurally undervalued. I mean, I can stand here with a straight face and say to you that I could put together a portfolio of businesses that are probably on a 4 to 5 year forward sales multiple of 1, and in many cases on an EBIT or PE multiple of 1. And if you just look at average sort of success rates in terms of clinical and commercial trajectory, that means that sort of probably 20 to 30% of those businesses will re-rate to a market rating, which implies 12 to 15 to 20x upside on those stocks. Now, it's not as easy as that. Otherwise, I'll just leave and go and make lots of money investing in this sector. Well, hopefully that may still happen. But why are these businesses so unbelievably egregiously undervalued as compared to their American cousins and people in other places in the world? It's to do with our capital markets and our investment industry, not to do with the commercial potential, the commercial trajectory of the businesses. And this is a source of enormous frustration to me and why I've just spent 3 years writing this book, to try and articulate in a long-form way, if in a small way I can have an impact on all the things that are causing this problem. So to unpack it still further, innovative biotech companies are definitionally smaller companies. To go back to earlier, they're all that sort of quantum size. They're also specialist investments. They don't have P ratios. They're not generating cash with a restaurant group or a factory or whatever else. They're very specialist. They have high science. They're R&D driven. That creates 2 really intractable, prosaic structural problems. They're too specialist for generalist domestic investors. So if you're a small business based in the UK, you can't go and get capital from overseas if you're below a certain, because all the big investors overseas have to cut a universe of investable assets at a certain point market cap wise. So you can't approach them. So you have to go to domestic investors. All of the assets under management in the UK that are run in smaller companies are run by generalists who see a brewing firm, then EasyJet, then Marks and Spencer's. They've got no appetite for or understanding of this sector. And that's a real problem. And then these businesses, as I say, are too small for the big generalists, most of whom sit in the States or Singapore or the Middle East, but very few of them sit in the UK. And so the joke I used to sort of come home to I used to say that I could literally call up a US healthcare investor like Wellington in Boston or somebody in California and say, I've got a biotech company that has a 100% response rate, pan-tumoral cure for all solid tumored cancers. And by the way, it also has a unit that turns lead into gold. And the answer would have been, I'm sorry, I don't have bandwidth to talk to management right now. Because it was a 200 million market cap business. It's too small, it's too far away, it has all the troubles with jurisdiction and time zone and everything else. So this is a massive intractable valley of death because Britain's quite good at supporting early stage science. we're absolutely awful at taking that and building FTSE 100 size businesses. Absolutely awful for all sorts of reasons. And also those Americans, because they have too much capital, their position sizes are too big. They'd have to buy all of a £200 million FTSE small cap business to make it worth their while. And they don't want to do that, obviously. And BD professionals, M&A BD professionals at mega pharma are similarly challenged. If you're at Bristol Myers, you do not walk in and tell your boss that you found a fabulous company that's capitalized at $40 million on the UK AIM market. Even if it might have IP that elsewhere in the world would be valued at a lot more than $40 million. To me, this is a clear example of what economists call market failure. There is no efficient market hypothesis in early stage small cap life sciences businesses outside of the United States. And that, as the Chinese say, the Chinese symbol for opportunity is the same as crisis, the yin and yang symbol. That hopefully is an opportunity. But just before we get excited about that, these problems are particularly pronounced in the UK, and this goes to why I threw the question out at the beginning of my presentation around how many stock market listed companies. I speak to financial journalists a lot. I do podcast interviews with finance-focused podcasters. I'm blown away by how few people know that stat. We've lost nearly half of our stock market companies. 30 years ago, the UK was 10% of the global stock market assets under management. Today, it's 4 to 5, depending on what you look at. British equities now trade on a 40 to 60% discount to equities, 60% to America, 40% to a lot of Europe and places like Singapore and Australia. So what does that mean? If you want to raise money to conduct M&A, you have to pay twice the dilution as a competitor in the States or Singapore or Amsterdam or wherever. So what are these companies doing? They're leaving. £300 billion worth have gone. And it's all fairly high profile stuff. If you read the financial press, Arm Holdings is the best tech company we've built in a generation, gone to America. So that's 300 billion. The opportunity cost of what we might have delivered in terms of economic growth and value is a multiple of 300 billion pounds. And the overall impact, that's the overall impact being higher. And who might be next? Because all of those big stalwarts of the FTSE 100 currently have pressure from activist investors to leave the UK. Because you would argue that if Astra or Glaxo relist in New York and leave the UK, they're like, well, Astra will add $100 billion to its market cap overnight. It doesn't quite work like that, but it's not far off that. And that means they have the firepower to go and do more accretive M&A and compete better with Lilly and Novartis and whoever else. This is happening at the moment. And it's not even an electoral issue, which just blows my mind. And down at the sort of level of perhaps companies you might care about more, smaller biotech companies. So 14 British biotech companies have floated on a stock market since 2018. 12 of them didn't do it in the UK. Because you can't. I can tell you from first-hand experience, it's almost impossible now. Loads of AIM-listed biotechs have delisted or even gone into administration, tragically. And I'll show you a little vignette in a minute that's hair-raising to the extent that that's often not their fault. And that's the Redex, what used to be Redex PLC, Redex now a private company. But, we believe our current market valuation is not reflective of our track record or future potential. And that sounds like a self-serving statement from a management team, but I'm here to tell you that that is true, and it's true for so many of these businesses. And it's part of the reason that you're talking about thousands of people being laid off. Loads more British companies on stupid, tiny little valuations when you consider the quality of their IP, the size of the total addressable market they're addressing, how far through the clinic they are. It's an insane situation that's very, very poorly understood. And so there's a slightly spurious throwaway example here as an exemplar, but is this about the quality of the companies or is it about capital depth? Uber lost $31.5 billion from 2014 till last year when it became profitable, and now it's a $160 billion market cap business. If Uber had been subjected to the same lack of capital depth and problems I'm articulating about funding in the UK as all of our British biotech companies are, it would have gone bust 7 or 8 years ago. So this is a problem we need to solve, because then we'll have more Ubers. Or biotech companies that are valued at $100 billion, is my point. And why? Why has this happened? Why? You can probably tell I'm particularly exercised about it. It's because we shot ourselves in the foot through terrible policy. And it's, by the way, it's not party political. It was under Blair and Brown. It began in the 90s, and it was carried on through successive Tory governments, and now it's just been supercharged by Mrs. Starmer and Reeves. It's ill thought out, not understanding the unintended consequences of their legislation because they've never spent a day of their lives working, in financial markets at the coalface of capitalism. Brown kicked it all off. I mean, he also sold all of our gold, which cost us 30 billion quid by now. Well done, Gordon. I mean, gold was obviously cheap when he sold our gold. But anyway, It has taken £1.5 trillion away from UK equities. And so that is multi-hundreds of billions of pounds that could be supporting the businesses that you're talking about and work for and work with, truly. And again, not an electoral issue, really poorly understood. UK equities were, our pension funds, of which there are about £3 trillion, used to be 50% in British companies' equities. Today it's about 3%. That's happened in 30 years because of this regulation, this diabolically stupid and ill-considered regulation. And if you want to, so this is not, so look, let's just do a comparative analysis of where our regulations driven us compared to the rest of the world. So what that chart is, if you look at Australia, so the top dark blue line, Australian shares, the ASX, is about 1.3% of the aggregate total value of stock markets in the world. About 1.3% of world stock markets are Australian. Australian pension funds, domestic pension funds, have 37.7% of their assets in Australian equities. Look at everywhere else. Japan, 4.4% of global equities. 49% of Japanese pension assets, domestic pension assets, are in Japanese equities. America, the Mac Daddy, is it on there? Yes, it is at the top. 43% of the global stock market is American equities. 63% of their pension assets are in equities. Where is Britain? Well, we were 10%, we're now 4.5%, and only 2%, 2.7% of your money, my money, our money. And that is why, this is a huge part of why Britain has a growth problem. It's a huge part of why you're seeing layoffs, because it's become virtually impossible to raise money. And why has this happened? Liability-driven investment, like we're the only country in the developed economy, developed world doing this. Tax treatment of dividends, stamp duty on stocks. One that gets missed a lot, failure to regulate crypto. There are now more British adults who are invested in crypto than who have a stocks and shares ISA. That is a national scandal and a tragedy, because that is several £billion. And several £billion doesn't sound like much in the context of the market cap of AstraZeneca, but in the context of small biotech companies that need 100 million quid to do a phase 2, it's the whole shooting match, alongside all of these other changes. Then, I don't want to get bogged down in MiFID II and RDR. This is FCA regulation alongside consumer duty that have compounded all this, made financial advisors, wealth managers, investment banks either extremely risk averse or out of business and gone. The 35,000 front office jobs have gone in the city in the last 30 in my career. JP Morgan used to have 25 UK equity salesmen. Today they have 1, and I wonder how long he's got left, to be honest. I hope you're not watching this. I won't say his name. I doubt he is. And all of this has driven the inexorable rise as well, the biggest equity theme. This is why the Magnificent Seven are all valued so well, so highly. The inexorable rise of passive, unthinking passive investing over active, which everyone will tell you, 90% of active fund managers underperform, but that misses the point. It misses the point of what the stock market, the purpose of the stock market is not just for your pension money, it's also to capitalize and fund innovation and companies. So if everything goes, John Bogle is the founder of Vanguard, the biggest passive player in the world, who said that passive ETFs should only be 15% of the stock market. They're now north of 50%, and they're more than 100% of under 40s investments in stock market equities. That is a real problem, because it means that you don't have an active ecosystem looking at these sorts of businesses, because all the money just goes in a tidal wave into Meta, Microsoft, Apple, et cetera, et cetera. That's a huge problem, and it's going to unwind in the next few years, in my considered opinion, because what goes up must come down. And when this theme unwinds, it will be just as hyperbolic, parabolic in reverse as it has been going up. So be careful and speak to your financial advisors about where your pension assets sit. Although if you're British, they're probably in underperforming bonds, which is why you will retire with £300,000 instead of £2 million if we had more enlightened, if we acted like Australia and everywhere else. British active equity funds have seen outflows for 47 of the last 48 months, to the tune of around £1 billion a month. So that's another £50 billion that's not going into the companies that you guys work for or work with. And the smaller company broking system in the UK has just been completely eviscerated. So we can't build large companies. There's Gordon Sanghera, the CEO of Oxford Nanopore. So what does all this mean? It means that if somebody gets offered £500 million for their business, they say, yay, and everybody celebrates and cheers and claps, and off they go. Alex Stormandy, former head of OSE, making effectively the same point, which means we don't even build £1 billion biotech companies at the moment, let alone 5, or it might consider it. If Denmark can build a $500 billion business from effectively pig farming, by the way, which was a remarkable achievement, because that's where the IP originally comes from. Why can't we even build one more Astra or Glaxo? Because we've resoundingly failed to do that because of everything I'm talking about right now. And this is particularly frustrating when you consider that the UK and Europe are home to 43 of the top research universities that are relevant to this sector in the world, as against 34 in the US, and publish twice as much relevant research, developing quality IP. We all know about Cambridge, Nobel Prizes, Oxford, and it's not just Cambridge and Oxford. Don't want to be too focused on that, but the IP coming out of those Cambridge, you'll know the development of Sir Gregory Winter and all these sorts of developments from the 80s onwards. This whole industry rests effectively on British IP, or a large part of it does, but our company formation lags the US by trillions of dollars, not billions, trillions, without exaggeration. And this, again, is a bit of a spurious throwaway comment, but Humira, as you all know, has done north of I think it's $240 billion by now, since launch. It was originally a Brit, it was Co, BASF, and Cambridge Antibody Technologies, wasn't it? But if Britain didn't have these challenges I'm articulating, that is a $300, $400, $500 billion company just based on the sort of PE multiple implied by making that much revenue. It's all gone to America. So there's Emma Duncan, the Times. Because of this, all of these businesses are moving over the other side of the Atlantic, and it's the same in Australia. And it's really rather depressing. And just to get even more depressing before I then finish with a few slides that are rather more uplifting before you'll get immensely despondent about the future. But I have to get this one off my chest because I work with them. So Redex Pharma was forced into administration in May 2017 because a vindictive individual, this is on the tape, can I scratch that and edit that bit? Because basically they called in a loan they'd suggested to management they wouldn't call in for sort of personal reasons, as I understand. I haven't been quite close to the situation. And it was for £2 million. So Redex was forced into administration. We ended up helping the hapless administrator. Again, I shouldn't say that on the tape, should I? Let's hope none of these people ever see this speech. But this stuff is important, right? Because they didn't know how on earth to value a BTK inhibitor asset, a local Liverpool, administrator. We helped them. We managed to sell it. You can imagine what a distressed situation this was for $40 million to Loxo Oncology, the BTK inhibitor. Is anybody familiar with this program in this room? Right. So Loxo was acquired 18 months later for $8 billion, and one of only 4 assets that were explicitly telegraphed on the press release for that acquisition was this program, now Loxo 305, Redex's BTK inhibitor, small molecule. That is now Jaypirca. It's on market, approved for the indications I've just given you, and they're looking for more. Global data have that as a $3 billion per annum drug. And thank you, sir. Can you do that more aggressively for everybody's benefit? I mean, it could be a $5 or $6 billion drug. So there is a British biotech company delivering fabulous IP. And look, we all know there are attendant risks on what was probably a phase 1 program at the time. But the only reason that this economic value has not accrued to the UK is because of the stupidity of the extent to which we've shot ourselves in the foot and the fact that our funding model has stopped working. But now let's talk about the opportunity. Crisis, the opportunity. So look, I think the valuation, this is sort of more or less inexorable, partly because of the exponentials. I believe it's the best structural opportunity I've seen in 25 years doing smaller companies, because so many of these businesses are literally on a PE of 1, or potentially. It's cheaper to do business in Europe. Everything's much cheaper in Europe. Ultimately, these are well-known quotes. If you work on a trading floor, the cure for low prices is low prices, or Ben Graham, Warren Buffett's mentor, always used to say, in the short run, the stock market's a voting machine. In the long run, it's a weighing machine. Fundamentals will out eventually, even if there's massive disequilibrium in the short term. KKR, very smart, big, deep-pocketed US VCs just seeded their London team with a lot of money. This is the first swallow of the summer, which is firms like Redex, which is now a private company, and Scancell, which is still listed. Now, basically, the majority of their shareholders are immensely smart overseas investors. So that sort of that problem of American specialists not being willing to look at UK companies is perhaps beginning to erode because enough is enough. They're so incredibly cheap. And as we saw earlier, there's $1 trillion worth of capital out there. And the most important thing of all for funding, for securing funding, is commercial delivery. Because you can't really argue with a business that makes it through, delivers an asset, starts selling it, makes significant profit. Stock markets will eventually value. An early stage R&D business is much harder to value and much more capricious. So the animal spirits of what NASDAQ values that at versus what London values that at, it makes the big difference that I'm articulating. But once you deliver profitability, it's different because of scientific progress and all the structural drivers I've given above. If you develop quality IP and if you're profitable, you will come to the attention of large specialist investors, because now you're big enough, because they can get enough liquidity to work. Generalists, because now they can say, oh, we understand what PE ratios are and return on capital employed, and you're making money, so I can interrogate you alongside a brewing company or an airline company. And BD professionals at large pharma, because these firms then become kind of sufficiently scaled to be of interest to mega pharma. And this is why some of these businesses have been in the past the best performing businesses in their respective stock markets. I believe there'll be quite a few more of these, particularly if you consider indexation, because if you get, in the UK, if you get to about 600 million market cap, you go into the FTSE 250, and then there's a huge swathe of index buyers from all over the world. In Australia, it's the ASX 300. And success begets success. So if I'm right, and we have 6 or 7, $3, $4, $5 billion sized British biotech businesses listed in London, all the big bulge bracket investment banks, Goldman Sachs, JP Morgan, Morgan Stanley, etc., will have an analyst on UK mid-cap life sciences in a way that they haven't done forever. That will then mean the buy side's more interested, big family offices will be more interested, global capital will be more interested, and then that's all this self-fulfilling upward spiral. And the other thing that I don't know what everyone feels about this statement, but the sort of management teams I meet and the stuff I came across researching this book, some of this stuff will be front page news. It won't be front page of companies and markets. It'll be front page of, tabloids, cure for cancer, stripping $100 billion that are cost out of the NHS. There's some really wonderful IP going on right now, as I'm sure you're all aware. And I think some of that, finally, the sort of complete lack of interest from the journalist community in these sorts of companies because of the inherent negative bias in our press. You'll hear a lot about war, famine, pestilence, COVID, whatever else. You'll never see a news report that says, great news, in a lab in Cambridge today, there was a fabulous breakthrough in a phase 2. Or, the stock market was up 2.6% last month. You only ever see when there's been a stock market crash. That's the only time, and that's why the public have such a distorted view of financial markets and capitalism. So all of that, there are a very clear set of steps to an equity story. And on this next page, I'm a stockbroker, so I'm cherry picking. So here is a company called Telix Pharma. What an amazing, so it's a theranostic precision medicine company. But crucially, this share price trajectory from 65 cents when it IPO'd in November 2007 to $28.50 that it's trading at right now, that's quite nice. That's 35 times your money since November 17. And why has it done that? Because it's exhibited everything I just said on the last slide. The market started discounting the commercial progress they're going to make, so it indexed. They got their product approval, they launched their prostate imaging product, and it's this commercial delivery point, which is that, so in their first half year out in anger making revenues, they made 24 million Aussie dollars. In the first half of last year, they made 365 million Aussie dollars. So now the index investors are investing, now the specialist investors are investing, now the generalist investors are investing because they can put a PE ratio on it because it's profitable. And it's now a 9 billion Aussie dollar business, and it's a very obvious takeout candidate for mega pharma that wants a precision oncology business like this. So it's not, a stock market investment isn't that easy, but I do think that there are going to be quite a few more of these, in Australia and the UK. And so before this theme plays out, I genuinely think there's a chance we'll go from massive, massive negative disequilibrium that we suffer today, and companies on fumes. I mean, you should admire anybody running a AIM-listed biotech business trying to raise money. It's just so difficult. And I think there's a chance that, as always happens in stock markets, they're in permanent disequilibrium. It's either negative or positive. So by the time this theme plays out, 7 to 10 years from now, in my considered opinion, the wrong trade will be the Magnificent Seven, and the right trade will be small cap UK biotech companies. Talking my own book, but let's hope it happens for all of our benefit. And in the meantime, the most tangible takeaways for everyone in this room, and to give a bit of a plug to Phraktion, as I suppose I should do, but appropriately, is that C-suite executives and everybody from them downwards in any organization in this space should be absolutely bolted on, focused on raising money, because it's incredibly hard, unless you sit in Boston and you went to an Ivy League college with all the big VC people. This should be front and center. We used to joke at my old employer that we should have a CEO school. And we should bring, I've seen CEOs just not care. This is the poor relation. They can go to the city and the streets are paved with gold and cap in hand, give me 50 million quid. It's not like that. And it takes a year. You have to go and set your stall out to a potential investor, whether a family office or high net worth or an institution. And then you say, this is what we're going to achieve in the next year. And they say, great, come back to us next year and show us how much of that you achieved. Only then will they write you a check. And time and time again, I only had a conference call with an Australian firm yesterday morning. That management team have fabulous IP. And they just haven't bothered to really think about investment. They just sort of pole up and go and talk to Macquarie Bank and think that they'll just magic up $100 million. And it just doesn't work like that. This has to be front and center, a focus for all senior management in businesses in this sector. And ideally raise more than you think you're going to need, because you always need more and you always need more time. And using capital efficiently has never been more critical. And so you should use firms like Phraktion to help you achieve that. Is that all right?
Brilliant.
Thank you very much.
Fantastic. Thanks, Andrew.